Good evening, all.
Good evening, ma'am.
Good evening. Assalamu alaikum.
Yeah, let us start.
Good evening.
Good evening.
Very good evening. Yeah. Yes. So, let's start the session. So today's session is it's going to be about how to make entries in the journal. Okay, so we are going to learn about how to make the entry of each and every transaction which the business has faced you're going to post it in the journal. Okay. And before going to that, we have to know about the difference between single entry and double entry system. So what are all the advantages and the disadvantages of maintaining single entry and double entry system? And we are going to see about few accounting terminologies. That is few terms or being which is used in the when posting the transactions, we will be using few accounting terms. So we need to know what are those terms and what does it mean, and then what is journal all about, okay, and how is it useful for the organization, and where it is used exactly, for what purpose, and what are the steps in journalizing. And we are going to see about one or two illustrations on how to make the entries. Okay, so let's start. So I was asking the last time, right? How many of you are already know the what do you say? Uh, have knowledge or know basic knowledge or already knew about the basic aspects of accounts. So one or two of you replied that you are from the accounting background. That is you have studied accounts as one of your subject in your uh, higher secondary or in your graduation stream. And even few of you have shared that you're having cost account as your one of your subject, or no management or financial account as one of your subject, right? So this just journal entry, it completely comes under financial accounts. Okay. So only after preparing the financial accounts, that is preparing the final accounts, which is profit and loss account and balance sheet. So from the results of the financial accounts, management account and cost account is being done. Okay. So first let's start with the uh, transaction entries of financial accounts. Now, I just want to know, inform that the whatever, we are studying, in our online session, the journal entry or ledger posting, and, preparing trial balance or profit and loss account and balance sheet. So everything is for your exam purpose. That is, you will be using all these knowledge and know whatever you're studying here, you will be, making it work out in your exams. Okay. Now, so nobody is no organization is almost no organization is maintaining any physical documentation of ledger posting or maintaining trial balance, preparing trial balance, or preparing the final accounts. Now we have many softwares for that. So if that accounting software is installed in your office systems, so all you have to do is make the appropriate journal entries. So the software, it automatically calculates everything, and it automatically posts all the transactions into the ledgers, and from ledger entries, it automatically creates trial balance, and from that it automatically um, calculates profit and loss account and balance sheet. So the system does everything. The software does everything. So you don't have to worry about how to prepare everything in the system. So you have specialized softwares for that. So your organization would have been installed those softwares in the systems. If at all you're working in the accounts department. So this thing, the journal entry or the ledger entry, or preparing trial balance, preparing balance sheet. So all these techniques and know-how, so everything is for your exam purpose. Is that clear?
Yes, ma'am.
Yeah. Oh, fine. So let's start. Let's start with let's see the difference between single entry and double. So single entry, it's just an old way of bookkeeping, and double entry, like usually at least for till 19 I would say till 2005, at least 2004 or 2005, the double entry system of bookkeeping was recorded, was maintained. So in most of the offices, even in what do you say, multinational companies or whatever it is, you could see that the accounting sections, the accountants maintained different ledgers, journals, and cash books, and different accounting related subsidiary books for making entries. That is physical documentation was being done. So every entry would be written and posted on the ledger, on I mean first on the journal and then on the ledger, and it goes like that. So it was like that till 2004 or 2002, 2005. Yeah. So by that time, a software called Tally, that came into existence. Okay. So Tally was an accounting software. So by installing a Tally software in the system, so an accountant's job, it made the accountant's job very easier. Okay. So all the accountant or the person who was responsible for maintaining accounts, for posting the transactions, all that person won't have to do is make the journal entries appropriately in the corresponding columns. That's it. Okay. So the Tally, that software, it does all the calculation by itself. It prepares the trial balance by itself, and from your side, that is from the accountant side, or the person who is responsible for maintaining the accounts, from the person's side, all he or she has to do is just cross check the transactions from the ledger posting and the trial balance prepared by the software. So that is what the person does. So once it is done, once it is confirmed that all the entries are perfectly fine. So again, there is a, what do you say, you can ask the software to prepare a profit and loss account. You can ask the software to prepare a balance sheet. And with those information, even the system can do a forecasting of the sales or marketing or whatever it is, production or whatever it is, in the future. It can even give you an insight about the sales forecast or marketing forecast or what do you say, production forecast, whatever it is, procurement forecast. So that is how it was being done. Now though you have many softwares. Now the Tally has become outdated. But instead of Tally, you have many accounting softwares, advanced softwares, which comes under ERP, Enterprise Resource, so ERP systems. Um, and accounting is being, it's considered as a part of ERP. Tally was considered only as a accounting software. Tally was designed for specifically for maintaining of the accounting transactions. But with the ERP software, you can maintain the information regarding the accounting transactions. You can maintain the information regarding the procurement being done, the sales being done, the marketing being done, whatever, the production being done, the HR functions, each and every department functions, is being recorded in the ERP systems. So it's completely interconnected. All the departments functions are interconnected in the ERP systems, and the software does all the calculation for you. So it's that much easy right now. Okay. And then you can see in the slide the difference between single entry, double entry. So again, this is for exam purpose. Just give a quick notice on this thing. So single entry system, debits and credits do not agree because it's just only the one entry. It goes with only one, entering one aspect of the transaction, and it doesn't go with the double entry transaction. But in double entry system, you have for every debit, there is a corresponding and equal credit. So preparing the final accounts, it becomes very easy while you are maintaining a double entry system of record. But in single entry system, since there is no equal corresponding credit or debit, so it's very difficult to calculate the profit and loss account and balance sheet. So that is the only difference. And single entry system was a very conventional way. Double entry system, now it has become a conventional way. Okay, since the software, since the rise of software, came into existence, double entry system, this has become it became a conventional. Clear?
Yes, ma'am.
Yes, ma'am, it's right.
Okay, let's move on to accounting terminologies. Let's see one by one. Okay, capital. So capital means the owner's fund. So whatever the owner has invested in the business, no, so that comes under capital. Again, here you have to be very, clear that the owner's account, bank account, the personal account is completely different from the business account, that is the organization's account. So it cannot be interconnected with each other. So business has to be seen as a separate entity. And whatever transaction happens, whatever comes into the business or goes out of the business, it has to be seen from the business point of view and not with the owner's point of view, but not with the no other shareholders' point of view. So from business point of view, all the transactions are seen and is being noted. So capital, it refers to the owner's fund, that is the owner's investment in the business. Then liability. So liability refers to all the debts, that is amount owed to creditors as well as the amount owed by the company, both in both the ways. So if there is the company is no liable to pay to other parties, so it means the company is a debtor, or if the other parties are liable to pay to the company, so the other parties are considered as the debtors. Sometimes all the purchases of goods or all the sales, no, it doesn't happen, no, as a cash transaction. Sometimes the parties, the suppliers, no, may sell the goods or may purchase the goods on credit. So it would be considered as a credit purchase or credit sales. So only if a transaction is being mentioned particularly as a cash transaction, so it has to be considered that, okay, so the party has paid a purchase with cash, or the party has purchased with cash, or the business has purchased something from the other party with cash. So if cash is not mentioned in the transaction, I mean in the sentence, so you have to consider it as a credit transaction. And assets. So anything of value owned by business, whether it's tangible or intangible. So anything which has a monetary value. So even if you take an intangible assets, so trademarks, copyrights, patent rights, goodwill, you cannot feel or touch these aspects, but it has a monetary value attached to it, because no one can duplicate it or use one company's trademark or patent right to nobody can use it without the consent of the business organization. So it has a monetary value too. So since it has a monetary value, that also is considered as assets. So all the tangible as well as intangible, uh, anything of value, owned by the business. Again here, so it's seen from the business point of view. It's not the owner's asset. It's not considered as the owner's asset. Owner might have invested in the business, but whatever is being purchased for the business, it is not considered as the owner's own purchase. So owner's own purchase is something different. The business purchase is something different. And then we have revenue. Revenue is something which comes as incomes. All the incomes gained by the business. So through sales or through commissions received or interest received or rents collected, whatever, in whatever way there is an income being coming into the company accounts, that is coming into the company's bank account. So that is considered as revenue. And then we have expenses. So expenses here, it is all the spent, whatever the company spends for, especially if it is for purchase of goods, for resale activity or for whatever. There is a purchase of goods or whatever goes out of the company, or the company is liable to pay to the other parties. That comes under expenses. So expenses, you have two different types: capital expenses and revenue expenses. The capital expenses is something so which can be generated year after year after year. So because like it adds value, I mean it adds more no interest or no it adds more interest to the capital. So once the capital is being like invested in the business, so year and year on the capital should grow. Okay, so that's how it is calculated. So capital expenses or something. So whatever being spent for, so it adds value, more value to the capital being invested by the owner. And then you have revenue expenses. So revenue expenses are something which is calculated for the current accounting year, just for 1 year. So for 1 year, it is no like the revenue is calculated based upon the procurement being made, the production being made, the volume being, like sold to the market, and the volume being actually sold to the customer, and the revenue being generated. So this one is calculated for just past 1 year. And then not the debtors. So debtors are all the people, if it is an organization or if it is an individual or it's no like it's no like any entity, which is liable to pay. No like so they are considered as debtors. So they have no like got the service or got the product from the company, but they haven't paid it as paid for the service or the product they have received. Instantly, they haven't paid, but they are liable to pay in the future. Creditors are the persons like who benefit, who like gives benefit without getting money, but liable to claim it. So anytime the company is liable to claim their money, like for whatever service they have given to the outside agents or outside parties or any individuals outside the organization. So those are creditors. And drawings. So drawings are like whatever the owner has withdrawn from the company's account. So that is like subtracted from the capital the owner has invested. For example, if the owner has invested 10 lakhs rupees as a capital to start the business, and after some time the owner takes back or like draws 2 lakh rupees. So it's like from the business point of view, it's seen as initially the owner has invested 10 lakhs, and out of the 10 lakhs, the owner has taken back, that is drawn 2 lakhs. So now the owner's capital is 8 lakhs. So here it's very clear that business is seen as a different entity and no owner is seen as a different person. And finally, you have purchases and sales. So buying and selling of goods is whatever it is purchase, and no whatever like you're selling, it's now comes under sales. So only if a cash is being paid for no purchase being made or sales being done, it's considered as a cash purchase or sales per se purchase. Or if cash is not mentioned at the transaction, it always refers to that is a credit purchase done or a credit sales being done. Clear?
Yes, ma'am.
Concepts of it, terminologies. Okay. Okay, so we are going to see about the journals. So what is a journal actually? So journal is like basically what do you say, a book or a spreadsheet in a software, where all the transactions are initially recorded. No, it's called the book of original entry, the day book, whatever, like the first book of like entries where the entries are made. So the book of original entry is a journal. So when physical documentation of was done, it would be like it was like very hard bound copy of the accounting notes, like binded together. So because it has to know all the transactions for past 1 year has to be recorded. Sometimes like even that would be not sufficient for few businesses. So once in 3 months or 4 months they would be purchasing new journals. So lot of transactions might be like happening there. So on each and every day, at least 10 to 15 transactions would be happening. So one journal wouldn't be like enough for them to maintain for one whole year. So every 2 months or 3 months, they keep on purchasing new journal notes and they keep on posting the entries. Okay, so it is like recorded in the chronological order. Chronological order means historically the transactions are entered date wise. Okay, so for easy identification of one particular transaction. So for example, after you have posted all the transactions, say after 2 months or 3 months, or when there is an auditing like happening in the business, in the organization, so you want to know about one particular transaction which has like happened in the month of April 2003. So you can easily check in the journal, turning to the pages of like April and check for the particular date, exact date. Why? Because it is like maintained in chronological order, that is in date wise. And every record of transaction is accompanied by a narration. Yes, narration is very important. Not only you're going to record the nature of the transaction, what has happened, who is the debtor here and who is the creditor here, and what is the amount, like being transacted or being, credited or debited. Not only that. So after each and every entry, a small narration has to be, like made in the uh, journal. Why? Because for easy understanding of the transaction. The recording of the journal is called journalizing. So it performs three basic functions: analytical, recording function, and historical function. So analytical function, it's the impact of transaction of ledgers and the debit or credit. That is analytical function is, so for each debit there is a corresponding credit. That is, if there is 8 lakhs, if there is a purchase made for 8,000 rupees, so that has to be mentioned in the debtor column as well as in the creditor column, because so the you have purchased something from goods has been purchased from an supplier for 8,000 rupees, and the company is liable to pay the same 8,000 rupees even if the payment is done after 6 months. So during this 6 months, the price of the product would have increased or the price of the product would have decreased. So that doesn't that doesn't mean they can go with any change in the uh, like the price of the product. So there will not be any change in the price of the product. But only if the company or the supplier agrees to give a discount on the product. So there is always a equal and corresponding debit and credit for each and every transaction. And recording function, and as I said, so in a chronological order, and not that is historical function. So recording function, you usually know it happens with like accompanying with the narration for easy identification of the transaction. And historical function, that is chronologically all the entries are being entered. So there are few steps in journalizing. First, you have to study the business transaction. First, clearly understand what type of transaction it is. Who is getting benefited, and know who is not like liable to pay. Which party is liable to pay to which party. So, and if there is a purchase or cash or what, I mean, if there's a purchase or sales, it is a whether it is a cash transaction or a credit transaction, and whether the owner has invested or withdrawn from the company's account. So what type of transaction it is. So identify the business transaction, and always look the transaction from the business point of view. From the business point of view, so what it is, whether it's like income coming to the business, or it is like going out of the business. So that you have to make it very clear and identify the accounts involved in the transaction. For example, I'm telling there is a a credit purchase being made from say Metro Sales Corporation. So the company has made a credit purchase from Metro Sales Corporation for 1 lakh rupees. So who are the parties involved here, or who are the as no what are the aspects not to be mentioned in the transaction entry is the company and the supplier. Supplier is no, here is Metro Sales Corporation, and nature of the transaction. So it's a credit transaction. So there are three aspects involved in this transaction: the company, the Metro Sales Corporation, who's the supplier, and the credit purchase. The credit purchase is seen as the different, no, like aspect. Clear? And then finally apply the rules. Applying the rule is like under which accounts no it comes, whether it's no like personal or nominal or impersonal, what type of accounts the a transaction fits into. And finally, journalize the transaction. Clear?
Yes,
Yeah?
ma'am.
Yeah.
Yeah.
Yeah, it would be more clear when you look up the transactions. So when you start, no, like when we start making the transaction entries, it would be more clear. Okay. So here is the example illustration. Here is how no the entries are being made. So is the slide visible to all?
Yes, ma'am.
Yeah, very good. Okay. Okay, so on the left hand side, you can see, so in 2023 September, so these are the transactions which has taken place for this much value. And here, this is no 1, 2, 4 or the dates in the month of September. This is not the no like serial number, but these are the dates. That is September 1st, this was a transaction done. September 4th, this was a transaction done. And September 30th, this was a transaction done. Okay, so these are the transactions which has taken place. And the task is you have to know like journalize these transactions. Okay. So this is how you are going to do it. First, no, like go with the clear content. Okay, so start with date, particulars, where no, you have to mention the type of transactions. Then ledger folio. Make a column for ledger folio. So ledger folio is something, no, like these entries, whatever you're, no, like entering in the journal, this gets posted in the ledger. Okay, so for cash account, there would be a separate column or a separate spreadsheet in case of no like software or separate what do you say page in the ledger. So you have to mention that ledger number, that page number here. So it's easy to know like identify the transaction, no like keeping it side by side. And then comes the debtor column and then the creditor column. Okay, so let's see on the first transaction here. So on September 2023, that is on first, owner commenced business with how much is this? 1 lakh rupees. Yeah, 1 lakh. So see the entry, see how it is being recorded. So cash account debtor 1 lakh to capital account creditor 1 lakh. So this is the narration. So each transaction should though like accompany a narration. So which clearly explains the transaction which has taken place. Here, the explanation is being capital invested in business by owner. Okay. So why cash account is being no like mentioned as a debtor? Why? No, the company has received something, right? So why it should be considered as debtor? Because the company is liable to pay back to the owner at any point of time. Okay, so that's why it is seen as no like a debtor entry. So cash account, because since the business has started with a cash deposit, no like so it's not like cash being invested. So it comes like cash account debtor to capital account creditor. So the here capital account, no like it represents the owner. Okay. See the second entry, bought goods for cash. So here you can see clearly, it has been mentioned that the goods are being bought for cash and not for credit. So in this case, you can directly mention purchase account debtor to cash account. So because cash has gone out from the company has no like given some money value, no, or the money to another party for purchase. Even though when they are purchasing something which is going to come into the business or which has already come into the business, so it's not considered as a creditor. whatever has come. Okay. So it is always considered as purchase account debtor to cash account creditor. You're going to see each and every transaction in the business point of view, from the company's point of view. And the third entry, sold goods to Karim on credit, 6,000 rupees. So here they have mentioned credit. So this is Karim's account debtor because Karim is liable to pay to the organization since there is a credit credit purchase being done from Karim's side. Okay, so he is like liable to pay back to the company. So the company has given him the value for money. So here the company is seen as no creditor, that is for sales account creditor and Karim's account debtor. Here the Karim has become a debtor. So the narration is being credit sales to Karim. And the fourth one, purchased goods from Matthew and company. So here there is no mention whether it is a credit or cash. So what will you consider? Is it a credit transaction or a cash transaction?
Which one, ma'am? Karim.
No,
Received
the
cash.
next
Which one? Purchased goods from Matthew.
purchased goods from Matthew and company.
Credit.
Exactly, because cash is not mentioned here. Okay, so we have to take it as a credit. So purchase account debtor to Matthew and company account creditor. And received cash from Karim. So for Karim, you have already sold the goods for credit, that is for 6,000. So for 6,000, Karim has paid back 4,000 to the company. So here the company receives money from Karim. So it's mentioned as cash account debtor to Karim account creditor. So still Karim is liable to pay 2,000 to the company. Then sold the goods to Gupta, 8,000. Again, there is no mention of cash or credit here. Yeah, so it has to be taken as a credit transaction.
Yeah.
Gupta account debtor to sales account creditor.
Sales account.
Yeah. Paid Matthew and company. We have already purchased from Matthew and company for 4,000. Now the company is paying back Matthew and company a partial payment of 2,000. Still 2,000, the company is liable to pay to Matthew. So Matthew and company debtor to cash account creditor. Since cash is being paid. Received the cash from Gupta, 5,000. So as cash, because we have sold Gupta for credit. So Gupta has paid out of 8,000, he has paid 5,000. A part payment is being received. So cash account debtor to Gupta account creditor. And then paid salaries. So pay salaries or all the expenses. So 35,000 salaries. So salary account debtor to cash account creditor. Clear? So these are the basic transactions. Is this clear?
Ma'am, I have a doubt in it.
Mhm.
In that particular cash account, DR means
Debtor.
Debit.
debit.
Debit. Yeah, debtor. Because the person who receives money or money value is considered as debtor.
Okay.
Yeah.
Okay, ma'am. Okay.
Yes. Okay. Is it clear?
Yes. Yes.
Okay. Yeah. So we can see, like one more illustration. Yes, for easy understanding. Yeah.
Ma'am, will they ask us to pass entries
Uh,
in the exam?
see, preparing journal, like it's a very basic entry. Okay, so you may not be, like receiving a question about, like preparing journal entries, but they may like ask you to prepare a trial balance.
Okay.
Yeah.
This is trial
So,
balance, right? This is journal
no,
entry.
this is not trial balance. This is just a
Yeah,
journal
this is
entry.
journal entry. Yeah.
Yeah. But for preparing trial balance, first you have to like prepare a journal entry and then go with the trial balance. That would be the best method. Few
Okay. You will show us an example. A refresher,
sorry?
I mean. You will give us a refresher
Yeah,
how to make
definitely.
trial balance.
Yeah, definitely. We will know like go still final accounts preparation. Don't worry.
Okay, thank you.
We'll go till balance sheet, no preparation of balance sheet. Don't worry about it. Okay.
Okay.
But you have to be like very clear about the journal entries, because since it is the basic of all the transactions, you have to know how to make the entry correctly so that there will not be any problem in preparing trial balance. And only from like preparing trial balance, result of trial balance, you would be able to prepare profit and loss account. Yeah.
Yes. Yes, yes.
Okay. So this is a very basic thing. You have to be very clear about it. Okay. So yeah, here we have like different transactions. Let's see. Owner commenced to business. Yeah. Okay. 5 lakhs. Purchased furniture for cash. Yes. Furniture account to cash account creditor. Purchased goods from N. So N may be a person or maybe a company. So since now cash is not mentioned here, it can be considered as a credit. Okay. So credit
Okay.
purchase for 1 lakh. Yeah. So purchase account debtor to N's account creditor. So if it is a cash transaction, if it is a cash purchase, here you can mention purchase account debtor to cash account creditor. Yeah. Okay.
Okay.
And then paid rent. So rent account debtor to cash account creditor.
Cash.
Okay. Then sold goods for cash, again cash account to sales account. Again sold
Okay.
goods for cash, 13,500. Okay, here is the uh, point. So here you can see on the same date, that is 12th of April 2018. So sold goods for cash 13,500, and we have given a sales
Discount.
discount of 1,500. So if you add up these two, the original money value would come around 15,000. The original money value is 15,000 for the sales. Yes?
Okay.
Yeah, okay. So here you are mentioning the transaction, no? Here the entry is being made at cash account debtor,
Cash.
13,500. Discount allowed to 1,500. And to sales account, that is the old money value of the sales being done, 15,000. So here you cannot like make another entry for discount allowed. So that will become a problem, and like the whole thing will become like it will not be like there will not be a corresponding credit column here. Yeah. So in the same
Okay.
column.
Okay.
Yes. In the same column, you have to mention cash account, and whatever discount you have been like you have given, that is the organization has given to the uh, receiver, or whatever the discount received to like from the purchaser, I'm sorry, from the supplier, or whatever brokerage or commission or interest amount, from banks or other, like commission agents, whatever. So it should be on the same column to avoid any confusion. So when you add up these 2,000, it comes to 15,000, and there is the corresponding credit for 15,000. So it is balanced here. Okay, paid to bank. So we always pay bank in cash, because bank don't accept like any credit, right? So it is always considered as a cash. Rent,
Cash.
salary, payment to banks, everything like electricity bill, whatever even if cash is not mentioned there, you have to take it as a cash transaction. So bank account debtor to cash account. Why
To
bank
cash.
account debtor? Yeah. So why bank account debtor? Because here you're seeing again, seeing the transaction from the business point of view. You're giving the money, bank is receiving the money. So you're considering bank as a debtor. Okay. So paid N for goods purchased. That is, you have already purchased from N 1 lakh worth of goods on credit, and you have paid 20,000 out of 1 lakh. So still 80,000 is pending. So N's account debtor to cash account creditor, 20,000. And then owner's withdrawal. So out of 5 lakhs, owner has withdrawn only 2,000, maybe for day-to-day expenses. So owner has withdrawn 2,000. So drawings account. So it's now considered as drawings account debtor 2,000 to cash account creditor 2,000. Again, it's balanced. So now the owner's capital is how much?
2,000 will minus from 5 lakh.
Exactly. Yeah. So it would be
49 lakh.
exactly.
48,000.
490,000.
4,98,000. So that would be
90,000.
the
Yeah.
capital. Yes, that would be the capital. So finally, paid salaries, of course, in cash, so 5,000. So salary account debtor 5,000 to cash account creditor 5,000. So clear?
Yes, ma'am.
Yes, yes.
Okay.
Yes, ma'am. Clear.
Yeah, yeah. So as of now, we have seen the basic entries. That is no like cash purchase or cash sales, credit purchase or credit sales, owner's investment and owner's drawings, and no like what do you say now, like paying rent and paying salaries and no deposit in bank. So in our further no like sessions, we are going to know like see in detail about no like the brokerage commission received and the no interest being paid to the bank and no like what do you say, dividend being no like distributed to the shareholders or whatever. So all those transactions. So how to make those entries? We will be seeing that in the forthcoming session. Okay, so hope no these two illustrations give you a basic idea about no how to make the how to post the transactions in journals. Yeah,
Okay.
yes. Okay, good. Okay, fine. So what we will do is to know like for better understanding of no journal entry. In our next session, we will have no like more illustrations. We will go with no like 3 or 4 illustrations with different type of transactions. So no
Yes, ma'am.
like
Yes.
yeah, that would be better so that you would be very clear about no like post how to post no transaction and entry in the journal. So once you are no like very good on that, you don't have to worry about the balance. So preparing the trial balance from the journal is no, it's very easy, very easy. And again, no, like from trial balance, preparing profit and loss account and balance sheet. Again, no, it's very easy. Yeah.
Okay, ma'am.
Yes. Okay. So that's it. We are coming to a conclusion. So proper bookkeeping, yeah, ensures accurate financial accounts. And yes, why it is used for enhanced decision making. As I said earlier, you might have no like you must be remembering. Trial balance is not prepared any time in the business. So if I want to know the current position of the organization, the present financial position of the organization, so what would be the present financial? What are all the aspects which comes under present financial position? That is how much the company is liable to pay to the outsiders, or how much the company is like yet to receive from the outsiders, and what is the present asset value of the company, and what are the present like liabilities. So how much expenses have been done as of now, and how much like how much like incomes have been generated as of now. So if I want to know about that as a owner or as a one of the shareholder, if I want to know about that, or as an accountant, if I want to know about those things, so immediately I can prepare a trial balance out of these journal entries or the ledger entries. So I would know like easily I can like identify. But preparing the final balance, it is done only for like taxation purpose, for auditing purpose, and for publishing in the media for no like interested parties. Okay.
Okay, ma'am.
So based on the trial balance, I can know very well go with no like any kind of decision making. So I would so if there is no like many no like so much of amount knowledge which is no like which is yet to be collected from the outsiders, no, from the debtors. So I might know like ask the team from my organizations to initiate to call everyone and ask for the payment immediately as soon as possible, so that I can easily run my company. So for any kind of decision making, I can very well like depend upon the trial balance, which can be prepared like any day in the no the year, any day in a year. And compliance and accountability is of course the preparation of final accounts. No, you're accountable as a business organization. You're accountable to the law, to the taxing authorities, to the government, to everyone. No, like to all the stakeholders who are no interested in the organization's financial position. Clear?
Yes, ma'am.
Yeah. Okay. So any doubts as of now? hope I'm not like rushing like too much. So I'm trying to do my best to give a clear idea about anything.
Yeah, ma'am, it's clear.
Yeah. Okay. So if you have any doubts, you can stay, or you can we can wind up the session. Anyone?
Okay, ma'am.
Mm.
Ma'am, whenever we are reading that transaction for posting, we have to keep in mind this, right? Debit the receiver, right?
Yeah, yeah, yeah.
And credit the
Whoever
giver.
receives the money or money value is the receipt. Yeah, debit.
For
Yeah.
example, that bank exam, you gave no cash paid to the bank, like paid
Mm-mm,
to the bank.
mm-mm.
So bank is the receiver in this case.
Bank is the receiver in this case. Yeah.
Okay. Thank you.
Okay. Then. So thank you guys. Have a great weekend. We'll meet in the next session.
Thank you,
Wish you
ma'am.
happy weekend. Bye-bye.
Thank you. Thank you. Wish you the
Yeah,
same.
okay, ma'am. Thank you. Thank you.
Thank you.
Thank you, ma'am.
Thank you. Bye.